Hello and welcome to 2302 Managerial Accounting Chapter Double Deuce. Yes, we're taking a double deuce here and dealing with basically responsible accounting. Yeah, we're deciding to make sure which managers are going to be responsible. And of course, whoever is responsible for this lecture is your good old friendly online YouTuber Professor Narragod, coming live. No, not actually live, but close enough. Yeah, so this chapter again is mostly dealing with the certain centers that we want to deal with, 3 direct areas of how we can basically measure performance. And these centers, and I'm not talking about the religious kind, I mean, that's up to you, but centers, we have first what is known as the cost center. That's this one right here, and let me zoom in more so you can see very good. Yay! So we have the cost center in itself. The cost center is basically, it's the one that incurs cost without really generating revenue. I mean, they're not directly related to it, they just basically create cost. And some of these departments include, of course, us. Yeah, we're one. We just do costs. Yeah, we don't generate revenue. It depends on the business, but we're just looking at manufacturers. So manufacturing departments, accounting, advertising, purchasing, human resource, mostly the admin stuff. We just create cost and we don't do revenue. Yes. So how do we measure this? Their success is actually controlling their actual costs as compared to the budget. So in chapter 21, when we dealt with variances, this is the big thing. This one will have where the variance should be variable. We're going to talk about this one, but it's not going to be too tough in this chapter. The next one is probably going to be the toughest one, and that is a profit center. Yes, never knew that you were going to deal with profits and centers at the same time, but yeah, this is a profit center. No, it really is profit center. And this one is our classic one. We know this one because it generates revenue with cost. So these are basically product lines. And they want to bring in Kraft Heinz, which is a great one. The beverages, I don't know exactly which beverage they're talking about that I've seen, but condiments, product lines, stuff that's actually going to be sold. At the same time, they have like cost of goods sold with it. They generate cost with it. And I mean, we're going to focus more on hardware and retail. They're a little bit easier to actually comprehend this profit center. And they're going to have revenue activities and other supporting activities when they're performed. So they're going to work a little bit with some administration, some cost centers at the same time. They're going to have a lot dealing with income. So to measure their success, it's basically, are they generating income? But also, can they manage their costs? So we're going to look at both of those when we're dealing with a profit center. Investment centers, these are centers that generate revenue and incur cost like our profit center, but they're responsible for making the investments. So see how we added a layer out of all these centers? Cost centers only deal with cost. Profit center deals with revenues and cost, while investment center deals with revenue, cost, and investments. And basically, that's buying our fixed assets or investing into other companies. So yes, you get to do that. That's actually fun. So, success in itself is how will they invest those assets to generate income? So, did they do a very good cost benefit? We're going to be checking on that. Maybe, maybe not. Who knows? Maybe it's just going to be half of them gone by a single snap. No. Anyway, so trying to make the video a little lively. So, when we discuss about these controllable costs within these various centers, it is to note who controls. In business, there is tons and tons of management, and if you mess with the family, we come for you. I could have been a contender. And for us, we have to see who's going to be over those costs. And so we got managers, which really, manufacturing department, let's take an example of that, is responsible for the costs that are controlled within that department. They cannot control costs that are allocated to them to a little bit of a degree. They can kind of hope that their percentage gets a little bit lower if they decide we're not going to go with that department. But mostly it's what they can directly control. Then the next level of management, like a regional management or anybody above them, they get to be in charge of multiple. They oversee a lot. Just like the all-seeing eye in Lord of the Rings, they're watching everything. And they're going to have to be responsible for all the costs controlled within that region. So that's their responsibility. And it moves up. So the best way to know this is always go look at an organization chart. Basically, who's responsible for who. If you haven't seen one, here's one. I love graphics, so let's zoom out so you can see the whole graphic. Okay, there we go. So this is an organization chart, and organization charts just basically say who's over who. So as you can see, we have a good old-fashioned board of directors, and they're over the president. President, of course, is over his vice presidents around the world, basically global. And we're just going to focus on the U.S. U.S. has 2 vice presidents under the executive vice president, and the West and the East. And let's go West because good old Texas is in part of the West division. And it has 3 departments that the West region vice president looks at, and they're all different plants. So you got plant manager for beverage, you got plant management for food, and then of course you got the manager for the service department. Okay, so this is the organization chart. It shows who's over who and who has to manage the cost. So zoom back in, zoom, enhance, zoom, zoom. So responsibility accounting for cost centers. This is basically all we're going to go over with the cost centers. So they will have a responsibility account performance report, and this is going to be comparing actual cost to the budget cost. This is what we did at the tail end of chapter 21. If you remember that, when we start doing those units and stuff, that's what we're going to use in this. If you don't remember that, go back to 21 notes, and not 21 Jump Street. Don't do that, because there's a lot of cops over there. They like to act like high schoolers. But you want to go back to 21, check out the videos, and you should be fine. Okay? So even though it's saying the next page shows this, there's not really much in here just for this little detail, but which we'll get into. But so the next page is going to show these performance reports that we're going to show, and it's going to show the organization structure through these points. So key takeaways to take from these reports. Low-level managers are responsible for detailed cost, while upper-level managers are responsible for a wider variety of costs. They're not just in charge of the details. Thus, detailed reports can de-emphasize the broader issues facing top management. Basically, there can be a lot of issues that we won't know if we're just focused on the details. So when we look at this, here's our little graphic, and here's our, oh, I don't like it when it does that. Let's see if I can get that to fade off. Nope. So, yeah, it does it after, of course. Anyway, so this graphic right here, this shows the performance reports, and it's going to show first, let's start at the bottom. Bottom's a little bit easier. So here's our plant management, and this is something that we've done. So we've got our control cost, and there's our big three. Here's our budget amount, and here's our actual. And this is our over/under. So we actually did good in labor and overhead, but materials, not so much. So that would have been a question for this manager. And we're 300 basically over. Well, their totals are going to jump up here. Since he's the beverage department, the vice president of the West region will have that in his report. But notice this, he's going to have a lot of other items that he has to deal with. And that budget department or beverage department is not going to be the main focus. Yes, it's over 300, but look at that. He's got two that are already over on other ends. His focus is probably going to be on those, and also see why the service department went under so much. But his totals jump to the West region up here, which goes to the executive vice president, and this goes over all his top controllable costs. So he's got the West and the East. Now, since the West is over by the most, he's probably going to question that, and he's probably going to question the East a lot because they are very under. So they may want to try and make the West close to the East. Vice versa if it looks that good. He's also probably going to ask about quality control costs, since that's a little high. But yeah, sometimes it can get blended in, and this manager may never talk to this manager because it's just so little, but he may be yelling at his food department to know what's going on. So that does happen, but this is just to show you how it works, how it goes through on these cost centers. We've already done this, so no worries on it. Here comes the stuff. Okay, again, the profit one is going to be your toughest one, and this deals with departmental income statements. So yes, we're bringing back income statements. So revenue minus expense equals net income. Yeah, they're coming in, but we're going to have to allocate. We're going to allocate stuff. And there's two things we're going to allocate. One is going to be indirect costs. And these are costs, of course, such as rent, utilities, depreciation, and they benefit more than one department. Then we're going to also allocate service department costs. And these departments are basically payroll, purchasing, human resources, HR, etc. that perform services, again, that benefit more than one department. So we're going to allocate these to how many departments we've got, based on percentages, based on square feet, based on a lot of allocatable parts. So we're bringing back chapter 17, or in some of the earlier chapters that dealt a lot with allocation. So since this really does deal with revenue and expense, here we go. Okay, so we're going to do the general model. We're not going to go wild and crazy. Of course, probably in your cost class, if you're an accounting major, you're going to go wild and crazy. Woo! Maybe that woke you up. Woo! There we go. Do it again. Woo! There we go. Went wild and crazy in cost. But we're going to use the general model. And this is basically, we're going to use the following process. The allocated cost is going to equal the total cost to allocate times the percentage of allocation based use. Should be something familiar. Again, that's from prior chapters. We're just showing you it in a different way. So we take it and we change it. That's how we work. Yes. Yes. So again, step-by-step process is coming along. And what is the step-by-step process? Since Professor Nergon loves to go step-by-step. And is it because he likes the new kids on the block? No. No, they're just easy to do steps. So, let's go. Step by step. Oh yeah. So, 1. We're going to allocate indirect costs to both service departments and operating departments. Step 2. We're going to allocate service department costs to operating departments. Step 3. We're going to prepare that income statement for departmental. So, quick note here. We always have a quick note. Zoom. Okay, it's in service departments, since they do not generate revenue, are considered cost centers. Operating departments, since they perform both revenue and cost generating activities, these are our profit centers. Okay, so always gotta have the quick note. Know the quick notes. So we're going to deal with A1 hardware. Yes, the barbecue company has now become hardware, and they are doing great. They're A1. And they happen to operate 5 departments, which are broken down as their 2 service departments are cost centers in the general office and purchasing, and their operating departments are their profit centers, which is hardware, housewares, and appliances, because they both buy and sell. Nice. And now we're going to look at how they basically break stuff down. So this is this chart right here. So this is to start off. This is how direct expenses are. So as you can see, here's our totals, sales. Of course, there will be no sales in our service department, but here's our sales here. And I will tell you, to do this, if you know Excel, Excel makes life easy. But since we can't get popped up on Excel right now, and it's good just to know how the charts are. So here's the charts, here's direct expense. So again, cost of goods sold, we shouldn't have any with service, and it should only be in operating. Salary, depreciation, and supplies, as you can see, has been broken down throughout all 5 departments, since all 5 will have them. And now we got all these indirect expense. Notice it's blank. It is blank. We are going to fill that in. So y'all ready? Let's see how it goes. So, first off, we need this information here. This is our allocation basis. Again, just like in prior chapters, here they are again. So here's the rent, and it will be broken out by our 5 departments who has floor space. Utilities are doing the same thing, so we can knock out both rent and utilities basically at the same time. Here's our sales. Again, sales is going to work with advertising. Only the ones that are generating revenue actually has any advertising involved. And insurance is going to be with everyone, because everybody's got to be insured, and it's going to be based on value of insured assets. And then we're going to get into these green ones, the general office and purchasing, and our step 2. Okay? So these costs right here, we got to know these. We're going to take these and this information, and we're going to start our stuff. So again, step 1, we're going to allocate indirect costs to both service and operating. So we're going to use that formula that we just showed you. So starting off, here we go. Here's rent. And by the way, great musical. You should listen to it. It deals a lot with the kind of AIDS epidemic, though, but it's actually really good if you're trying to see how well to stay positive when you're broke. Hey, singing does everything, but it's got a little good situations. But anyway, with this, as you can see, here's our departments. Here's that allocation base that we just had. And then what we need to do is you're basically going to take whatever the office space, divide by 12,000. So small number divided by big number, and you should get your percentage. So see right here, this is what we did. Yay! So small number divided by big number. That's how it basically is, because it can't be bigger than 12,000. So you can take their number and divide by the total. It's really what's going on to get the percentage of allocation base. From here, all these, if you add them all together, should equal to 100%. So that's cool. Once we have this, here's our formula. That formula right here, just right here. So take your cost, which just happens to be 12,000 also. So it made life easy for us, but times it by our allocation base should, when you times them, will come out to the allocated cost. I would always double check and add these back together and see if it comes out exactly like your cost to be allocated. Okay? So that one made it a little bit easy, but don't think that all costs are going to be the same as the square feet. No. Utilities are not that way. Yes, it's using square feet, so it's going to have the same percentages. But notice, its cost is 2,400. So it's going to be a lot less. So we have to watch out for these. Again, to check, boom, these total up to 2,400. That was the cost allocated. We're good to go. No math problems. Here is it for advertising. Same premise. So I'm going to move a little bit faster with this, because really the notes is showing again, the tables just doing the same stuff. So, and then here's our insurance. Okay, same items that we just went through. Take the small number, divide by the total, and you get your percentage. Times that by whatever cost they allocated, and you get your allocated cost. So, after that, we spread it out. So we spread out those indirect expenses among the 5 departments. And with that, we only want to do the total cost of the service departments, general office and purchasing. Why? Because now those 2 departments are going to be broken down and allocated to these 3. Okay? So with that being said, now we can do step 2, allocating these service department costs to operating departments. So, how are we going to do that? We're going to use the same formula. It's exactly the same as indirect, except we're now using this general office, the way that we had it, and the purchasing. So, back up here. Go back up here. Remember this green ones? Here we go. Notice that they have costs only for hardware, houseware, and appliances. General office is only going to use sales. Purchasing is only going to use number of purchase orders. And that's our allocation base. So, right here, here's our sales. Out of 239, here they're allocated again. And times by our costs that we figured out in step 1. So these 2 numbers right here, for general office and purchasing, that's what's going to go in the cost to be allocated. Times by our percentage, equals our allocated cost. Okay. Next, we do it for our purchasing service department. Sweet. So, same thing. We're taking our number of purchasing orders, take how many for each department, divide by the total, get us our allocation base, times that by the cost to be allocated that we figured out in step 1 by our percentage base, and boom, there's our cost to be allocated. Now that we did the service departments, and believe me, you're going to have software in the real world, and of course you got technology to help you out because again, businesses have more than 5 departments. They're going to probably have a lot more. So this can get complicated. We're trying to keep it simple. But after you allocate those, we're now able to really do the income statement. This is the departmental income statement, step 3. Notice how it's broken down. We have sales. So here's our sales. Then we have that direct expenses that we had in the first that was already allocated because they're directly related. And notice that we'll figure out operating income before our allocations. So this is how they look before. Next one, we do our indirect expenses. So it shows how much expense got allocated to each one. Then we got our service department allocations, so that general office and purchasing. And then finally we get our operating income loss. So to figure out this, basically after you taken sales, which is revenue, minus all the expenses, that gets you this one. Take that one and basically minus all of these will end up to your operating income. Notice the last department, appliances, is at a negative. Okay, so this is where it basically goes. The operating loss of 525 could be an issue, but is it really? It's just like playing Pokemon Go and you capture a Pokemon and go, is it going to be is it the real Pokemon or is it going to be a Ditto? Because it's hiding. It's like a ninja. It's hiding. Could it be an issue? Yeah, a ninja could be an issue because ninjas are there to kill, but we'll see. Maybe it's a good ninja. But could there be an issue? Can we tell? Now, when we look at just direct expenses, the stuff that the manager can control directly, we notice that the appliances department has a positive operating income of $9,500. The manager of the appliance department also does not have full control over the allocation of indirect and service. We have that. So they don't get to choose the allocation base or get to choose how much of these costs come to their department. So really, we do know that they're making the revenue of the costs that are directly to them. So it could actually be a non-issue because if they had if they allocated their way, probably won't have a revenue. But we can conclude this. At the department level, management's performance should be evaluated by operating income that reflects direct costs or controllable costs incurred by that department. However, including these costs may encourage the department manager to attempt to limit its usage of service departments, using them for only critical purposes. Basically, we can charge them with their direct, but we want to add that fear factor into them that helps them to reduce the cost for the service departments and thus makes it more efficient. If they only use them when they really need them, then it lowers cost and lower cost for their department. Even though we may not actually using them in the performance report, it's always good to have them to run that scare tactic. Also, from a higher level, above the department, those vice presidents and so forth, the operating income after indirect and service department costs should be considered for overall department profitability. Okay, so higher level is going to probably look at the everything. Lower level, it's a scare tactic. Okay, so that's the profit center. Profit center, I would say, is probably the hardest one to get your head wrapped around, just because there's so much involved with it. But once you get that formula down and understand it, you're good. So let's add in the next part. Investment centers. Okay? And investment centers can be evaluated using both financial and non-financial measures. So we're going to get into both of these. With the financial performance, we have one big item that we tend to use, and that is the return on investment. Basically, when I buy this asset, how much money am I going to get back? Am I going to get enough back to basically make up for buying that asset? Well, for it, the formula is basically this: investment center income divided by investment center average invested assets. Okay? And to get the average invested assets, take your beginning assets minus your ending asset amount and divide by 2. Very easy, very quick. Okay? So, ROI can actually be broken down even further. And I will tell you, it will ask in problems on Connect in the homework to find profit margin and investment turnover. So ROI is profit margin times investment turnover. So our profit margin, which basically reflects the percentage of sales that a company can keep after incurring its expenses, is going to be investment center income divided by investment center sales. While investment turnover is basically how quickly can we flip these assets, how efficiently these assets basically generate sales before expenses are incurred. So they're making money enough to cover expenses and all that. So that's going to be our investment center sales divided by investment center average invested assets. So as you can see, the components are up here. And basically once you times these, if you know your algebra, we'll have a butterfly effect going on where we have one variable on the bottom, one variable on the top, and they basically cancel each other out. Okay. The other financial one that we're going to end up using is residual income, or RI. And this is investment center income minus target investment center income. And this is expressed as a dollar amount. The larger the difference is, the more income was generated by the investment activities and more value added to the company. But this target income is also set by management, and it's usually a percentage of investment assets. So we're going to have to convert that percentage into dollar amount. I know, fun stuff going on, yeah, woohoo! But you know what? You can do it, and we're going to go through it. So let's use A1. And A1's back, and it's got investment center income of $600,000, investment center sales of $6 million, and average investment assets of $7,500,000. And they want a target income of 6% of average investment assets. So how does this work? Well, let's start off with ROI. And ROI, again, is our investment center income divided by average investment assets. And this problem states 600,000 divided by 7.5 million. And we get a good old 8%. Not good, not bad, it's somewhere there. Okay? RRI, though, is taking the investment center income minus our average investment assets times our target income. This figures out what our target income is. So 7.5 mil times 6% gives us 450,000, which is cool. Awesome sauce. So once we subtract that out, it shows that we have 150,000 in residual income, our extra value that has been put on, which is great. We love that. Woohoo! So, but let's say the problems go on and start asking for other stuff to get to ROI, including profit margin. Well, if it's going to ask for profit margin or investment turnover, you gotta remember this. It's center income divided by center sales. So 600,000 divided by 6 million gets us 10%. And then we have center sales divided by average investment sales to get our turnover. So 6 million divided by 7.5 mil gets us 0.8 turnover. So if I did multiply these two, like I do here, gives me the same ROI. So you still get the same. So if you ever want to do a double check and you just got those info, you can do a double check. So, quick note, ROI generated by profit margin and investment, should equal, I already did that, so still a quick note. That was a quick note. So, issues with determine these inputs. Again, there can be issues because there can be fraud and all that. Average investment center assets should be impacted, could be impacted by extreme additions or disposals of assets, especially at the end of the year. Management's probably trying to get rid of a lot and they're also buying a lot. So that will throw off the ROI. Again, even though it's the average assets, if there's so much in the back, they weren't hold for a long time. So they're not utilizing the income yet. So it's throwing off the ROI. It's making basically a lower ROI than it should be. Investment assets are typically measured at their book values. So cost less accumulated depreciation, which also means lower book values as themselves. So this can also throw off and give you a larger ROI or residual income figures and not necessarily reflect the true potential. So it does again also add a little problem. And the last one, investment center income needs to exclude interest expense and tax expenses to reflect more honest evaluation. This usually doesn't happen. So, and it actually causes a little trouble there because these are dependent upon other things, but sometimes they get thrown in with the investment center income, which does not help us at all. So we have another performance measure, and this is the non-performance for our investment centers. This is known as the balanced scorecard. So to do non-professional, so again it pops up some examples. Additionally, they're greater focus on short-term financial goals instead of long-term, stuff like that. So we do need this like matrix, and it's going to blend in 4 various parties that are impacted by the investment center activities, and that includes the customer, the internal process, innovation and learning, and financial. And through these, they'll have different subsections of how they evaluate. So for example, customer, we have the customer satisfaction rating. So again, blow it up for y'all. We have the customer satisfaction rating. We have the number of new customers. We got the percentage of on time, percentage of sales, times of filled orders, percentage of sales return. All these put in the customers and they all get rated. And this is the time when you get surveys. And be honest, since you are the main focus of companies, you want to you want to do these surveys. It helps them out so much. That's why they offer a chance to win $500 or stuff like that, because they're trying to get this information for their scorecard. The same thing with the internal process. We have certain roles, innovation, and financial. Okay? And financial, you see, this is where ROI, net income, cash flow, residual, all those come in. So, we're going to take a little example, and this is known as key performance indicators. This is pulled out from the balanced scorecard, and we'll look at these. And these are normally called KPIs. If you've ever been to GameStop and you go look at one of the computers on the register that they constantly look at, and you see those circles, this is their KPI. This is how the store is rated. If the store doesn't do so good in it, well, they get recommended, and then they'll eventually get closed. So KPI, again, we'll look at the customer perspectives, potential customer purchases, orders returned, customer satisfaction rating, and number of customer complaints. We're going to look at the actual, and then we're going to compare it to our goal. This is what we kind of want to happen, and we notice that this, comparing the two, the trend is going to go up, has to go up. It's green. Right now it's 62%. The trend is probably going to stay the same, and actually is showing that it's staying the same. So we need to go up with that one. We're okay. Here it's neutral, but we should go up a little bit more. I mean, it's right now the same, but we want more. Here we definitely want to reduce. If the actual complaints, which is a bad thing, it's something that's a red light. That's something that we're going to be going, we need to work on. Okay? So, that's one of the ways that we look at it. And the other non-financial measure that we have is known as cycle time, or basically cycle time and cycle efficiency. Cycle time is how long does it take the product to be produced or service to be produced and either sold or finished. And since we're looking at manufacturing, we're going to look more on the production cycle. So first we have process time, and this time is value added time because it is there to produce the product. So time spent working on producing the product. It's going to have something that's going to create revenue. Inspection time, no value is added because it's just a cost to us. So again, this is time spent inspecting the raw materials, work in process, finished goods, whenever they got to make sure everything's correct. Move time, no value added, again, more cost. And this is time related to moving the materials, work in process, finished goods, and so forth and so on. And then wait time. How long does it sit? I mean, if it's sitting there for a long time, that's not good. So we have 4 key areas, and we're going to add those all up together, and that's going to create our cycle time. So our cycle efficiency is going to use that cycle time, and it's going to take the value minus added time, or basically process time, divided by cycle time. Okay? So here's our example with A1, and they are going to deal with a process time of 1.8 days, inspection time of half a day, move time throughout the process takes about 1/7 of a day, and then wait time, it sits for 3 days. That's a big wait time. That's not good. So when we add those all together, we find out that for the product to go from production, that gives us value, to selling, or basically sold, sits for almost a week. It takes about 6 days. Not the greatest. So how efficiency is this? Well, we take the process time, which is the 1.8, and divide it by 6, the cycle time. And we find out that's only 30% effective. Yeah. So the rest, that 70%, is non-value money in the cycle time. There are activities that do not add any value and they just cause cost. That's not good. We want that to be either 50-50 or 60-40, somewhere where value time is a lot higher. So A1's going to look into this, and they're going to check their processing of wait times, move times, and inspection time, and they're going to see if there's any way to reduce this process. And if there is, yes. So again, they want to have more time spent on value-added activities than it's sitting for 3 days. Okay? So that completes chapter double deuce 22. So, oh boy, you just finished 22. Dun, 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 dun. Whatever that Taylor Swift song goes through. So, but 22 is now done. It's in the books, and we're going to close this chapter. So this is Professor Naragon signing off, and I will see you in the next video.